Hello, hello, hello. Welcome to the stream, everybody. So, I'd like to welcome you back to, two guys play with a portfolio. We had a little bit of audio issues last time, and so we're going to put together, apologies for the mess, a quick stream today just going through the portfolio. For those tuning in for the first time, this was roughly a 20K portfolio of gold, predominantly in GLD. Over the past couple of episodes, we've started to merge this portfolio, adding some short Chinese financials, in particular Minqing and Chinese Merchants Bank. We've added some short tech banks in the form of Silicon Valley Bank. We've added some inflation-linked bonds in the form of bullish options on that ETF. And then we've added actually some protection to the portfolio in terms of some 25s, 40s, and 27 bull call spreads on VIX over a couple of maturities. We can do a quick run through of the risk in this portfolio. So let's start. The portfolio is now, as of today, because gold is up long, 115 delta dollars in gold. What that means is that for every 1% move that gold makes, this portfolio will make 1.15% just in delta. But you can see that actually this position has a lot more in it. If we look at underlying GLD, most of our long exposure, most of our positive exposure in this book is gold. If GLD were to fall to 140, the book would be down about 10%. If it, on the other hand, were to go up to 180, would be up around 10%. So we have pretty good convexity in this position. We like this position. We're going to keep it. Today, we're going to actually look into maybe putting more of that position in options. Yesterday, the stream that had no audio, what we did was we actually showed how you can use options to maintain that same level of exposure to gold, that same level of delta, but with radically different margin. We reduced our margin from around $7,000 to $5,000 yesterday while maintaining the same exposure to gold with a lot more upside. So we think that's a much better portfolio, way more interesting for folks. And you can see right now, a lot of our margin, interesting, is this Silicon Valley Bank position, which that's got to be from the initial because it's not that big of a position. So let's go over here, Silicon Valley Bank. Let's go risk, SIVB. It's only 1% of the portfolio in delta space, right? So I don't know why the margin would be so high on that. We need to check that. This is the wonderies of working with brokers. In terms of the Chinese stocks, we have some margin tied up in that as well. Here's what we got in gold. Here's what we got in VIX. Pretty small position in VIX. Reasonably sized position in tips. And we didn't get the dollar on yesterday. Okay, that was the thing we tried to do, where we don't have permissions apparently, even though I don't know. Like I can't buy one of these even. Yeah, not gonna let me. So how are we gonna get long dollars? Well, we tried to do it through CNH. I don't know why I'm long Hong Kong cash. We should probably clean that at some point. FX trader. Not today. Okay, so what are we gonna do today? Well, we had a request on the internet to look at all of the gold. So what we're going to do, log into Rose. I'll do it over here. There we go. So first of all, why are we long gold? Well, we're long gold because over a very long period of time, gold does pretty well. And partially as what I call, a good diversification portfolio. So we're not going to do it today, but over the next couple of days, we'll build a beta portfolio and we'll show how long gold in dollars or double dollar gold is pretty helpful to a portfolio. And I can show you just right now how it is helpful to a portfolio. On stream live, so that's double dollar gold. Looks kind of weird, right? But if you think about the drawdown of that and compare it to the drawdown of equities, or the drawdown of bonds. What you're going to see is that USA, let's see, loop, loop, loop. Yeah, so it has a lot of diversification benefit because it's really rallying when everything else is crushing, especially in the 70s. And so it's a very good portfolio to hold for these periods of time. And I can show you that live on stream. Let's multiply this by 0.8. And we're going to add some double dollar gold. Multiply by 0.2. And we're going to take the return of that, and we're going to look at the drawdown of that. And we're going to compare that to just stocks on their own. So how does adding a 20% weight of double dollar gold help you with your stocks? Great, so you can see it cuts that pretty well. If we take this and we say double dollar gold, let's say US stocks plus 20%. It's kind of a hacky way of describing it, but 20% double dollar gold return equals, here we go. So what I'm doing right now is I'm just creating that logic of 80-20 multiplied by 0.8 multiplied by 0.2, and I'm pushing it to rows. I'm sending it to rows with a new name, this line, right? And now if I want to say returns of that line, I can take that object and take another version of it, which is just the returns of it. So it goes up, it goes down. I can track that. Okay, and let's do a rolling sharp of that. Roll sharp 250. Let's do 10-year rolling sharp. USA equity returns. Really hard asset to beat. Amazing asset to beat. Can we beat it with a little double dollar gold? It looks like we can. By a little bit. And then how much does that actually matter? So if we take this and we look at the roll standard deviation, 250, how much does diversifying benefit get you? So X returns, roll standard deviation, almost done. Yeah, so that means that if you are, let's revol this to 16. And then you put them on the same volatility, meaning you can add a little bit of leverage because this difference in portfolio vol has a huge difference over the long run, huge difference. Okay, and we can even put that in log space just to show everyone at home. And so this is going to be USA stocks plus returns, and we're going to revol 16 vol, meaning we've turned this into an asset which we think is 16 vol. Now, there's going to be some more complexity there. I don't want to get into it right now around how you do your vol targeting and this and that, and we can talk to AQR about that later. So here we go. Get rid of these returns because we're just looking at the revols. Returns, 16V. Here we go. And these are both since, okay, 1904. I don't know why that's where it is right now, but that's fine. So we'll call this return and return, and we'll call this, and this is the part where eventually robots will do it, obviously. Wow, look at that. And drawdown. So similar drawdown. Not, I mean, way better in the 70s, right? Not that much better, but remember, these have been vol adjusted. And then that compounds over long periods of time. How does that change the year-over-year change? And this will be our last chart. And we haven't even looked at bonds yet, right? And this thing's going to crush bonds, but we just have not that much time. We're already out of market hours because we couldn't trade anything. Terrific. It doesn't really change anything, Camel. We need more double dollar gold. So we'll look at that later. We'll send it out as a tweet. This is going to be called double dollar gold plus stocks, USA stocks. 20% portfolio risk testing. At date. Okay, great. This is partially for a client that's asked us to do this, but now we go back here, right? And okay, so we made $80 today, basically nothing. We paid for our theta. Our theta was 15. How do we make money today? Well, let's do a little bit of active brokers training, everybody. So one thing that's really helpful to get is your P&L. Are they gonna make this hard for me? All. Whoa. I tried to hide my. There we go. Okay, sorry, I got distracted. What are we looking for? Risk manager. No. Let's go here, empty. New window. They really hide it. There we go. Okay. They bring me back to there. Okay. I'm gonna delete position change. Maybe there's a limit on how many of these I can have. What is going on? Okay, we gotta do this later. Sorry guys, I know this is terrible. Let's go back here, equity. Maybe because it's here, right? P&L for the day. Boom. Okay, so where do we make money today? We made money on gold. Gold's up. We lost money on VIX. VIX is down. That sounds about right. So gold's up a little bit. Dollar is down a little bit. Bonds are up more than tips. Oil is going to be down, right? Yeah, so oil's down. Well, that's good. Deflation is good for the Fed. It allows them to stop tightening, which allows bonds to rally, which should be good for stocks, which, you know, all these things are good for asset prices. And a good reason why VIX is low. I guess the question then just becomes, why is credit so janky right now? Because VIX is down. Let's look at HYG. You know, HYG versus TLT is kind of like a, yep, so credit's coming in. So let's look at iTraxx main. Is that, it's a return index. Okay. Nice. Okay, what about Credit Suisse? These are my bellwethers. Credit Suisse CDS. Still hanging in there. What about Deutsche Bank? And then UniCredit. And then Barclays. Ooh, okay. This is bullish. We'd update our spreads data. Oh man, okay. Spreads are coming in. Great. Okay, that's good for everyone. Last but not least, how are spreads doing in China? I'll leave you with this. Okay, well, there's your there's your asset class to take a look at. We think that the next move in this is pretty clearly down. There's a couple different ways to get it. Pretty hard to get it. You can do futures if you're not a retail punter like me right now. But in general, we think now is a pretty good time to short CNH or CNY or whatever you can get, especially against yen, because they're, I think, going to shift tighter. China's going to have to shift easier. If you look at the lockdown news, it doesn't look like they're really going to change lockdown that much. And even though the property stimulation's coming, so they're going to try to, extend and pretend on property. But if people are getting locked down, how much can they go out and spend? So there are some, murmurings on the internet of what I think is pretty good monetary policy, which is just printing money and giving it to people and having them spend it. And, Xi can do that with people in their home, on their phone. So there is stimulation possibility if they want it. The real question is, how much to rear-rent the domestic industrial economy, and what happens to all the industrials in the way. Like, for example, let's look at Shanghai. What's in this, right? This is the private sector, or the drinks, bank, oil, financial, power, energy, financial, energy, retail, tourism, bank, food, bank, telco, right? So banks, right? And then coal, Costco shipping, just mentioning, aviation company. Anyway, so there's a whole side quest to do here, but you would expect to see some pretty healthy movement here. Interesting that Hang Seng looks a lot worse. So how much can that recover? I mean, it's a pretty big move. But we'll see what happens next. So sorry for the kind of disorganized stream today, guys. Wanted to just give you a quick look at that portfolio, because yesterday we did an hour on it, managing the portfolio, but all the audio left. So hopefully next time we'll be able to go through how to build that portfolio in a way that people can see and appreciate, and I'll be dressed a little bit less like a hobo then.